Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. There's no doubt about the main headline of the week, that being the decision by Rishi Sunak to call a UK general election, that vote to take place on July the 4th. Perhaps surprisingly, perhaps unsurprisingly, the market reaction was relatively muted. The bookmakers have made the Labour Party such a strong favourite to win a majority at the election that there's no change in expectations. It's already in the price. So we'll be talking about that with my two guests this week. Charlie Morris, the CEO of ByteTree Research, an independent investment research firm. Charlie used to run asset allocation for HSBC back in the day, but now runs his independent boutique. Has a particular interest in gold and Bitcoin, but also ranges widely across the market spectrum. And also been talking to Andrew McHattie, editor of the Investment Trust newsletter, one of our regular updates on some of the most interesting recent news. And that will include talking about the latest updates from the likes of Scottish Mortgage, Asia Dragon, HICL Infrastructure, Capital Gearing Trust and Chrysalis. Turning to the markets, we can say that the All-Share Index was down somewhere in the region of 1%, whereas the S&P 500 over the water was basically flat on the week, and the Japanese market was down around 1%. The main action, perhaps you could say, was in the gilts market, where we saw price declines across the whole of the maturities spectrum, with low coupon, longer dated issues down the most, around 3%, the most affected individual gilt. So that representing a further rise in yields and continued story of delays in the hoped-for cut in interest rates that many have been banking on but not yet seen materialize here or indeed in the US. The Investment Trust Index was also down short end of 1% this week, with the average discount moving a little wider again, up to around just over 14% as of yesterday morning. Looking in more detail at the winners and losers, well, there were slightly more losers than winners this week. Among the gainers, most notable, I think, was the continued good showing by specialist smaller company investment trusts, with Rockwood Strategic, Addition, which this week announced an impending tender offer after its first 7 years as a listed vehicle, and Montanaro UK smaller companies, all doing well, up quite nicely this week. Whereas at the other end of the ledger was once again with those bond yields rising, we saw declines for most of the interest rate sensitive sectors, including infrastructure in particular. We'll be talking about that in a moment. Turning to results, there were 6 companies reporting full year results out this week, and most of those we will be discussing in a moment. But among them, Scottish Mortgage, Capital Gearing Trust, STS Global Income and Growth, HICL Infrastructure, Caledonia Investments and Shires Income. You can see details of all those results in our regular weekly summary of news available to subscribers to the Moneymakers Circle, where this week our investment trust profile features RTW Biotech Opportunities, ticker RTW. We do have a profile of Scottish Mortgage, ticker SMT, coming up in a couple of weeks' time as well. So do please look out for that. Elsewhere, the main news coming out of the sector this week, apart from results, concerns what you might call the exit stakes, what I perhaps will tongue-in-cheek call the exit stakes anyway, news about those trusts which are either at risk or definitely going to be winding down and going out of business. So in that category, I could mention this week Aberdeen European Logistics Income, ticker ASLI, which has concluded following a strategic review that a managed wind-down is in the best interests of its shareholders. As it says, returns would be, I quote, materially in excess of that achievable from the indicative cash offers received, all of which were subject to a number of preconditions and all of which represented material discounts to NAV. This follows a strategic review which led to a number of approaches for this particular trust. There'll be a circular in June in advance of a shareholder vote on the necessary changes to achieve this managed wind down. 80% of shareholders in GCP Asset-Backed Income also voted this week that the trust should be discontinued, although a suggested amendment to the investment management agreement passed with a much smaller majority, while the planned managed wind-down takes place. However, bucking the trend to some extent was US Solar, ticker USF, which held a discontinuation vote this week at its annual general meeting, but there 65% of shareholders voted against the proposal, preferring the trust to continue in business. And finally, on the takeover front, there was a further development concerning Asia Dragon, ticker DGN, the Asian specialist trust managed by Aberdeen, which recently completed a merger with its sister trust, Aberdeen New Dawn. And as you will recall, there was what some thought a cheeky approach from Ashoka White Oak Emerging Markets, a much smaller, very small emerging markets trust, which made a proposal to take over the running of this newly combined vehicle. What happens now is that the board has come out in response to say that it has appointed a consulting firm, Stanhope Consulting, to help it complete a strategic review, and said it would be, I quote, interested to consider proposals from established fund management groups with experience of managing equity strategies similar to that currently pursued. Well, I don't know whether that was a particular swipe at Ashoka White Oak with its emphasis on established fund management groups, but we shall see where that one goes. It does mean that the future of this particular trust is also now definitely up for grabs. Ashoka White Oak, meanwhile, said that it intends to pursue its involvement. There was one obvious place to start this week when I sat down for one of my regular chats with Andrew McHattie, editor of the Investment Trusts newsletter. We're going to look back at some of the announcements that have come out this week, of which perhaps the most pertinent is the announcement from the Prime Minister that we're going to have an election on July the 4th. That will mean that it's 4 years since the last election when Boris Johnson won with a huge majority. And yet, this time, it's extraordinary how things can change in politics, isn't it, Andrew? If you look at the bookmakers, it's basically there's hardly any point in having the election because they're just assuming that the Labour Party is going to win, and not only win, but win big with an overall majority. So let's start with that. Did that announcement take you by surprise, as well as a number of other people?
Well, it did. I assumed, as did probably most people, that Rishi would hang on until the very last moment to see if he could capture some improvement in the economy or some better news to try and swing the polls. But that hasn't happened. So, yes, Parliament will be dissolved at the end of the month and we'll see exactly what kind of majority the Labour Party gets. It does appear to be a foregone conclusion, although you never know. And so on that basis, perhaps it's not introducing that much extra uncertainty to the markets. But yes, a surprise, I think, for most of us.
The bookmakers' odds are certainly extraordinary. Labour majority government is 7-1 on, and no overall majority coming in some way behind at 13-2 against. And they're predicting that the Tories could lose more than 200 seats. So that would take them back down to a sort of rump of around 150, which is one of their worst performances ever. But as you say, the markets had a long time to contemplate the possibility, and you would assume that most of what people are worried about will be priced in if they are worried about the outcome. Gilt sold off a little bit this week, but that, you could argue, was not particularly to do with politics. So the biggest uncertainty for investors, anyway, as far as this is concerned, we know that the Labour Party has been making a lot of generalised statements, but there's still a lot of uncertainty around what they might do in terms of particularly of taxation and in terms of making life better for British business, if they can do that. The numbers of the UK fiscal situation are pretty dire. They're going to be dire for whoever comes in, aren't they?
Well, you could argue that actually this is a fairly negative print for the markets in the sense that perhaps the Conservatives have looked ahead to what economic news may be coming down the line and decided it isn't that attractive, and so they may as well go now. I think there's one specific issue for investment trusts that we should talk about in relation to the dissolution of Parliament, though, which is that, of course, this means that all current legislation stops, including the progress that's been made on the cost disclosures, of course. And one can imagine that with a new government, with a fairly full agenda of policies that they're very keen to implement, the parliamentary schedule is going to be extremely busy for quite some time. And so my feeling is that, unfortunately, the investment trust issue is going to get pushed well down the agenda from here.
Yes, it's not going to be high on the list of priorities, is it, unfortunately? Meanwhile, we've seen the average discount on the sector. It has come in a little bit, but it's retreated back to around 14%, something like that, as we're talking. What do you make of the performance of investment trusts so far this year? The investment trust index is up around 4.5%, something like that. But there have been quite a lot of winners and losers.
There's certainly been quite a dispersion of returns, that's for sure. And overall, it's been a slightly disappointing start to the year. We probably did begin with high hopes, actually, that these discounts would come in a bit more quickly than they have. They've shown signs of narrowing, but there's not very much momentum behind that. And the investment trust sector has certainly lagged the FTSE 100 index this year. So it hasn't been brilliant overall, but of course we all hope to pick better stocks, don't we, than the average. And if you've been in the right sectors, such as growth capital and technology, and certainly avoiding the interest rate sectors such as infrastructure and property, then you could certainly have done much better than that. And there have been some very strong performers, led by trusts like Seraphim Space and Baker Steel Resources Trust, Rockwood Strategic, and the Shipping Investment Trust. There's been quite a lot of good news in here.
We have seen this historic moment when the FTSE has actually gone above 8,000. I remember having a conversation about 15 years ago with someone who said that we'll be lucky to get to 8,000 in the next few years. Well, it has taken an awfully long time. But meanwhile, the UK equity market has actually perked up a little bit and the small cap sector has been improving. Do you have any favourites among the smaller companies specialists?
It's an interesting question, that one. It's not necessarily British companies suddenly finding they're in demand, and overseas investors still don't want to buy British smaller companies. But actually overseas corporates do. So we're seeing lots more M&A activity, and that's benefiting actually some of the operators at the smaller end, like Rockwood. My approach to this for some time has been to combine actually one of the large general smaller company trusts with one of these specific small ones. So in my newsletter, I recommended holding Aberforth smaller companies along with Rockwood Strategic, because I think it's quite difficult just to pick one UK smaller companies trust from the long list that exists. And they're not a homogenous group, are they? There's plenty of variety in there. So that's why I chose two, I think, at either end of the spectrum in terms of the size.
Yes, and we also heard, funny enough, from Odyssean Investment Trust, which is one of the sister trusts in the Harwood stable with Rockwood Strategic, and they had a bit in their portfolio as well this week, which perhaps they needed because their performance has been relatively poor compared to the others recently. I guess there will be more, won't there? Or do you think that perhaps this is somewhere where the election may actually stop one or two bidders from coming in if they're afraid that there may be some changes coming? Do you think that could be a factor?
It could be, Jonathan, but as we were saying, I think the market has been pricing in a Labour government actually for quite some time, and equities generally seem quite sanguine about it. There hasn't been too much speculation that there's going to be massive changes, I think, to the economy in the near term. So I doubt whether that will put off overseas buyers who are seeing such incredible value in the UK market. UK companies are so cheap that actually a change of government is probably a small ripple in the ocean. That's not going to put people off.
Well, let's talk about some of the news that came out of the sector this week. Let's kick off with Scottish Mortgage Trust, ticker SMT, managed by Baillie Gifford, of course, and if you exclude 3i, the largest investment trust that we have. What have they had to say this week, and what did you make of their announcement?
Well, it was their annual results for the year to March 31st. We already know what the outcome is because, of course, the NAVs are announced well ahead of the results. But it was a better year for Scottish Mortgage. Not a brilliant year, but better. Their net asset value total return for the year was 11.5%, a double-digit return after a couple of tough years. But that wasn't really tremendous given where they're invested in a lot of large US tech companies, which of course have been powering ahead. But what's happened here is that there were some quite differential returns from parts of their portfolio. So the trust did very well, of course, from Nvidia, which is now its largest holding at 8% of assets. We know that Nvidia has really been storming ahead and actually moved ahead sharply again this week. But on the other hand, Scottish Mortgage does have quite a significant proportion of its assets in unlisted holdings, which lagged behind the performance of public markets. So it was slightly mixed, but overall I think most investors would be reasonably happy with that double-digit return. And there's quite a lot else going on with this trust, of course, with its buyback programme, with Elliott Management's stake now being reduced. And there's a lot of comment about this trust all of the time. So investors are certainly, I think, quite well informed as to what its prospects are.
Yes, it's been a tough period for them in terms of they had board ruptures, obviously, and a lot of questions about the valuations. But they seem to have come through that. The new board has got 3 new members, and it's certainly made a mark with its share buyback plan. They always emphasize they're a long-term investor, long-term growth investor. They're looking for the companies that are going to make a huge difference over the next 10, 20 years. But they have sold a couple of positions. They sold their position in Luminar and they sold their position in Tencent. And, of course, they did have a very big exposure to China. And I rather get the sense that maybe they're trying to scale that Chinese exposure back somewhat, given recent developments. And there was interesting commentary, I thought, about AI. Obviously, everybody's talking about AI, and NVIDIA is, if you like, the cheerleader of that whole thing. In the announcement, they quoted this professor in America who said that AI is going to be the most significant invention since the printing press. If you believe in AI as an investment thesis, if you don't think it's become something of a bubble, then this is still a very good way to play that, is it not?
Well, you've made some good points there, and obviously introducing the word bubble into the conversation is always slightly frightening, but you're right. There's a great deal of excitement, obviously, about AI. Baillie Gifford, as a management house, has always had this almost evangelical zeal about growth companies and is very much committed to putting its capital there in these long-term winners that it's trying to find. There are good opportunities here for investors to back the AI revolution if they have faith in it. Having a spread of investments devoted to AI in Scottish Mortgage or Manchester and London is a good way to go about it.
Yes, I've just been looking at the share price of NVIDIA again. Of course, after last year, when people started saying, oh my God, this is ridiculous, it can't be sustained. I mean, the shares have doubled again this year alone. And the chart looks like one of those classic trees don't grow to the sky kind of charts. It's almost vertical, which is always a slightly worrying concern. What about the discount? Scottish Mortgage is trading, I think, on around 6%, something like that at the moment, discount. And the board reiterated that they were committed to trading around NAV, which I thought was quite a strong statement. They didn't need to say that. Do you think this one could go back to par? Is that a reasonable possibility, do you think?
At the moment, there's a great deal of pressure on the board, I think, to maintain its buyback programme. And there's a specific reason for that, really, which is that on the 8th of May, Scottish Mortgage bought back a massive £311 million in one day, which was a record buyback. And that was, of course, largely to reduce the stake of Elliott Management, which had a significant stake in the trust. And now many brokers are saying, well, that's fine, but actually this share buyback program was not intended to provide liquidity for one large US arbitrageur. It's really there for everybody. And so you really must maintain this and really enable other investors to get out at a similar price to Elliott in order to maintain fairness. It probably does need a significant shift in sentiment in order for the shares to get back to par again. But that's a possibility.
Well, let's talk then about the interesting developments at Asia Dragon, which is managed by Aberdeen and has recently obviously completed a merger with another Aberdeen Asian trust, Aberdeen New Dawn. But of course, we know that there's been a development there, which is that they had what looked like a rather cheeky bid from a very small trust, Ashoka White Oak Emerging Markets Trust, which I think may have taken the board by surprise. And we've heard more from the board this week from Asia Dragon about what they're going to do. And perhaps you could tell us what they said and what you make of that.
I consider this the most extraordinary story, actually, Jonathan, because if you had suggested to me a couple of years ago that a £35 million investment trust with a one-year track record would consider taking over a long-established £700 million investment trust that had also recently instigated some significant corporate changes itself, I wouldn't have believed you. But here we are. This is the situation. So Ashoka White Oak effectively told the board of Asia Dragon Trust that it was thinking about a takeover and had the support of more than half of the shareholders, which really came as a great shock to me and to the board of Asia Dragon Trust. It took them a little while to respond, but they have done now, and they've instituted a strategic review, which obviously gives them a bit of thinking time. But what they've said is that they will consider approaches from other fund management groups as well as the existing incumbents, Aberdeen, and we'll have to see what comes of this. It throws up all kinds of issues around the amazing thirst for change there is in the sector. The fact that shareholders would have considered shifting to Ashoka White Oak at this point is quite remarkable in itself, I think. And it also shows, I think, a very new and dramatic degree of power wielded by these trusts that do have a good performance record, a narrower discount, and a manager of good standing. I think should Ashoka Whiteoak be successful here, they're really flinging the doors open for a big expansion in corporate activity. This could actually usher in a completely new era.
Yes, I can't recall anything quite like this in terms of the sort of David and Goliath nature of this particular approach, though I think they were at pains to say that it was initiated by the shareholders of Asia Dragon rather than by Ashoka Whiteoak itself. Ashoka Whiteoak have an Indian trust which has been hugely successful, and it was interesting talking to them a year ago when they actually did the IPO despite raising only a tiny amount of money, which everybody said, well, that's ridiculous, why would you do that? Well below the threshold. But they talked about having ambitions to grow. And as you say, this whole discount issue has thrown up some intriguing possibilities. I guess one has to say it is a bit of a slap in the face for Aberdeen, which has been going through its own issues, had a lot of scaling back, reducing, consolidating, all those kind of things. So is it possible that Aberdeen could hang on to this particular trust now, do you think? If so many of its shareholders are against it. It seems unlikely to me.
It does seem a bit unlikely, doesn't it, really? And I think you've got to feel a little bit sorry for Aberdeen in this case because they did effect this merger in November, so it's quite new, and the managers haven't really had time to bed that in and to demonstrate, what they can do in terms of performance now with the combined vehicle. But it's a tough old world out there, and there's a far lower degree of tolerance now for any degree of underperformance, I think. And I think with Ashoka Whiteoak, they have a pretty valiant and worthy opponent here. I tuned into a presentation from the manager, Prashant Khemka, a week ago, and he does make a very convincing case, actually, because Ashoka Whiteoak is really set up with quite a large team, and they have a lot of resources. So whilst they were a bit unfortunate with their timing of their IPO, only managing to really struggle to raise the minimum of £30 million, I think they're really set up to be a much larger trust. And the manager is certainly very much hoping it will follow the path of the Indian trust, which has grown very substantially over time.
But now that the board's effectively inviting a lot of other managers to come in and make a pitch for the assets, it's a very chunky trust, as you say, significant size, and it has had very disappointing performance. I think in the Asia-Pacific sector, it's the worst performer of the 5 trusts in the sector. So I imagine there'll be a flood of people wanting to try and take it over. Can you think of any obvious candidates who might be interested, apart from Ashoka Whiteoak coming in?
Well, the beauty parade could indeed be a very, very long one, couldn't it? I think it could be a very long list of managers keen to take on these assets. It's £700 million. It's a lot. And I suppose one interesting angle on the Ashoka proposal was that they were planning to include a 50% exit opportunity, which is much, much higher than is common in these situations. And I would say that's pretty attractive for shareholders, but not necessarily so attractive for the board, of course. There's plenty of big players in the Asian sector, and Schroders spring to mind actually as one of those. It probably doesn't play into the hands of value investors very well, because I think that's been part of the problem here for Aberdeen, that their staunchly value approach hasn't really played out that well.
Yeah, and of course the other thing just to mention is that the shares, I think, are still trading at a discount, around 10, 12%, something of that order, which in the general context is not perhaps as bad as it might be, but that's around the average, I think, for the emerging markets sector. So the market perhaps is not entirely convinced exactly what the outcome will be. Let's move on then and talk about some other results that came out this week. Let's start with HICL Infrastructure, one of the sort of core infrastructure trusts that have been around for quite a few years now, been hit by the rise in interest rates and interest rate expectations. That tends to drive the performance of this trust. But what did they have to say this week?
Yes, again, they were reporting their results for the year to the end of March, and they revealed a net asset value of 158.2, which was down over the year, which that was really expected because of the increase in discount rates. But the trust has been quite busy here. They've been selling off some assets and reducing their debt as a result. And overall, I thought it was a very satisfactory set of results, actually. And there was some good news buried in there, which is not immediate, but it's really to do with the dividend payment, which is a very significant reason for holding this trust, probably the most significant. Most people who own it will be looking at the income here because the yield on the shares is 6.6%, and that's really why you buy this. The dividend has been held actually for a couple of years at 8.25 pence per share, so you've been getting no growth in that. But the trust has indicated that it will be targeting 8.35 pence for the year to March 2026, which sounds a long way off, but actually that's the next financial year. And it's a fully covered dividend. There's also buybacks taking place, and that's significant because the shares are on a 24% discount here, which is something we thought we'd probably never see. This was a trust that traded on a premium rating for a long time and was really regarded as very much a blue chip investment trust holding, I think. It's a £3 billion trust. Many people will hold it, and they would not have expected this degree of share price volatility. So I think now you can hold it with a prospective yield of 6.7 from that rising dividend again, and you've got the potential upside from buybacks as well. And I think it's been prudently managed. It's likely to remain interest rate sensitive, of course, because it's regarded as a bit of a bond proxy. But in my view, I think it's a fairly comfortable holding for risk-averse investors from this point.
Yes, I mean, you mentioned the discount. It is extraordinary in the context of history. This trust listed in 2006, so just before the global financial crisis. And apart from that brief moment during the financial crisis, it's nearly always traded at a premium ever since, until the trust government, I suppose, and the whole issue around interest rates. And the dividend is being resumed again. And they made some realizations as well, I think. That's the other thing. They have actually been stressing how they've been active in moving the portfolio along by disposing of things at a premium to NAV and so on. So they seem to be doing all the right things, but the market just doesn't seem to want to know.
No, I think that's right. Actually, if you look at what the managers have been doing, it's almost the playbook for good, prudent management. And so I think there's nothing to complain about here.
So let's also then talk about the Battery Storage Trust, which we talked about not so long ago. We had some announcements this week from that sector. What, if anything, is going on there? We haven't seen that much improvement in the performance of the Battery Storage Trust after the traumatic month a couple of months ago. What are they saying now?
Well, there's quite a bit of news here. There's quite a lot of chat anyway, even if there's not that much in the way of movement in share price. So we've heard from two of the three. So first of all, Gore Street Energy Storage, which is slightly different from the two peers because it has considerable international exposure. It issued a trading update on the 20th of May. This is a trust that has maintained its dividend while the other two have stopped their payments. So it's interesting to see just how they're planning to cover that. The positive spin on this is that actually the trust did reveal a small increase in revenue and profits. But actually, given that it had a 45% increase in its battery storage capacity over the period, you might well have expected a much bigger uplift. So it was left actually with dividend cover of 0.56 times. So barely half of its dividend is covered by revenue at this point, which does indeed raise question marks over its sustainability. But what the trust says is that actually a lot of extra capacity is coming online because it's still building out its portfolio. And by the 2025 financial year, that dividend could well be covered. And the trust has done well actually from its assets in Ireland and in Texas, which have really counterbalanced the very poor performance in Great Britain and also in Germany. And there's some degree of improvement in the revenue returns from their GB assets. There has been some shift in the algorithms used by National Grid, so that is slightly improving. You're able to buy these shares on a discount of just over 40% to NAV and to take that yield of 11.4%, which sounds very high, but of course it is an uncovered dividend, and therefore there's very little guarantee that it is going to continue in spite of what the trust says. We also heard from Gresham House Energy Storage Fund, which announced a very small increase in its net assets for the first quarter to just over 130 pence, again helped by the completion of the construction of some assets there. So again, its operational capacity is growing quite sharply, and it has said there's been an improvement in its GB revenues, which are normalising to some degree. But I think there's a long way to travel here actually for this trust before things are truly back to normal, which is why it's on a massive 57% discount. So I think it might be a bit too early to get excited by that one. We needed a couple more quarters of improvement there before we can jump in and say, yes, things are really, truly better.
Yes, I think normalising to some extent is probably not the strongest statement you've ever heard from an operating business like that. The Labour government, we know it's scaled back its green energy commitments. Well, we don't know exactly what they're going to do about net zero and so on if they do win the election. But it does remain the case that whoever wins, this is still going to be an important sector. There's a lot of money tied up in these battery storage trusts, and so it is important, I think, for the country as well that some of these trusts do at least start to perform better and actually get more power into the grid. one has to hope that that will happen.
I think that's right, Jonathan. In almost every meeting I've been in with these trusts over the last couple of years, they've been asked about the Labour government and what might change. And they tend to brush it aside, actually, the managers, because they say there's very strong cross-party support for renewable energy and for the need to develop this industry. And battery storage is an integral part of it. If you are willing to take a speculative position, then actually these discounts are probably already putting a lot of the bad news in the price.
Let's talk next then about Chrysalis. We had Richard Watts on the podcast last week talking about the trust, but I had to record that before there was this media story about one of its significant investments, a company called WeFox, which is involved in providing solutions for insurance companies. What do you make of the situation there? I mean, the market didn't like that media speculation at all, did it?
It didn't. It really didn't. I saw the shares drop very sharply towards the end of the week, and I had to hunt around actually to find the reason, because there was no initial RNS announcement. And it turned out to be this report on Sky News with the chief executive of WeFox, who indicated that the company could be heading for insolvency this summer if it didn't make good progress selling some of its loss-making subsidiaries. And I think perhaps there was some degree of milking the publicity there to try and push this along and to make his mark as the new chief executive. We've subsequently heard from Chrysalis that actually they've been discussing this for many months with WeFox and that there's nothing new there and that they're confident of continued shareholder support for the company. But they probably would say that, wouldn't they? The important aspect here is that actually WeFox is a very significant holding in Chrysalis. At the end of March, it accounted for just over 14% of NAV, which I've worked out is about 21 pence per share at that point. And the shares dropped about 15 or 16 pence on this news. So actually, they've dropped by the bulk of the valuation here, really indicating that they're giving considerable credence to the Sky News story. We'll see what happens next with WeFox, but it's clearly a slightly unstable situation.
Yes, I was a little bit surprised by the scale of the reaction because, as you say, Chrysalis clarified this week that they had put some more money in to help the next funding round. There have been a lot of funding rounds of this particular company, and they sought to present it as being business as normal. But it does at least raise a query. Growth Capital Trust generally, HICL and so on, they have been performing reasonably well. But Chrysalis has not done quite so well. It's down 3% this year to date. There's been a big broker push behind the trust. So I think it's unfortunate. Do you actually own this one yourself, Andrew?
Well, I do, and I must say I bought some more actually this week. So there you are, you put me on the spot. And the reason I've topped up actually is that I do feel that actually incorporating pretty much the whole of the value of WeFox into this market decline was an overreaction. And I think it's perhaps that actually growth capital has generally done quite well as a sector this year, but sentiment is still quite fragile around it, which means that actually any bad news tends to evoke quite a strong reaction. And I suspect this was an overreaction. I'm prepared to be patient with this one, Jonathan.
Good. Well, I hope you don't have to be patient for too long. Also reporting this week, we heard from Capital Gearing Trust, ticker CGT, the well-known, what I like to call the sort of defensive multi-asset investment vehicle, listed in the flexible investment sector, one of 3 or 4 companies that seek at least to provide an absolute return over most 12-month periods. What did you make of their latest figures which came out this week?
Yes, this is a trust I follow. It's an important trust in the flexible sector, and the highly experienced manager, Peter Spiller, is always worth listening to. The NAV total return for the year was 1.8%, which was slightly behind the trust's benchmark. And in a way, that's not too surprising because actually these kind of trusts that are positioned cautiously do tend to lag bull markets. The trust itself did admit to being slightly too cautious, and that has been a detractor from performance. But it did well from some aspects of its portfolio. It did very well from its holding in Pershing Square Holdings, for example. Didn't do so well from its holdings in infrastructure trusts. But I was interested in a couple of aspects of this. First of all, it's just good to know that the trust buyback problem has been resolved, because you might remember that it ran into a technical issue where it was unable to continue its buyback of shares, so it couldn't maintain its zero discount policy totally effectively for some time. That's all over now, so we expect that zero discount policy to come back into play properly, and the trust is currently on just a 2% discount. The other aspect that was interesting for me was the outlook statement. And here Peter Spiller said that he was actually still very cautious about equity markets in general and slightly fearful of the high valuations in the US. I think that's a very valid point. But he also pointed out the really tremendous value that we're seeing in investment trusts and these very unusual discounts that we're seeing at this point. I suppose for us, Jonathan, because we're talking about this on such a regular basis, we're embedded in the sector and we're used to talking about these double-digit discounts and how maybe they varied from 16 to 14 or whatever. But actually, this isn't normal, and it's an unusual phase here where we're seeing so many super wide discounts of 30 or 40%. And there's value in the sector. So it's good to hear from Peter that he agrees with that.
What dragged down the performance in this period was their holdings in the infrastructure trusts. We've talked about one of them already in the form of HICL, which returned minus 15% over the year, and that's where the trouble was. But it's interesting to hear Peter saying, actually using the word fantastic prospective returns with relatively low risk. That, from a relatively cautious manager, is a pretty strong statement. And they've been adding materially to their holdings in that infrastructure now makes up 8% of the portfolio. I think it's notable also that after that mishap over the discount control policy, they have changed their marketing and administrative arrangements, and they're talking about being more proactive in marketing the trust. I think that's part of a general trend across the sector. Finally then, just looking ahead, we've got some political uncertainty. We're not quite sure where interest rates are going yet. There's still hopes of a cut quite soon in UK interest rates, at least. We're going into the summer months, which are often relatively weak compared to the autumn and winter. What are your general thoughts about where we are in the markets? Have you been doing any other buying and selling in the last few weeks?
Well, we've had quite a good run, of course, in the market overall. You mentioned the FTSE 100 index finally getting quite significantly beyond 8,000 for the first time. And investment trusts have participated in this rally quite well. I do worry now that there's a bit of scope for profit taking. And for me, the most important driver is still interest rates. And so it was very disappointing this week, actually, that the inflation figure of 2.3% was slightly ahead of expectations, slightly higher, really because of services inflation. And I think that's tended to push back expectations of the interest rate cut. It's still coming, we're told, but it might now be August rather than June. I think the interest rate environment is still the most important driver for the investment trust sector, actually. There are so many trusts that are interest rate sensitive, especially in the depressed areas of infrastructure and property and so on. So I think there's a bit of scope, actually, for profit taking to maybe pull prices back over the next couple of months. So for me, this is not a time to get too excited. And of course, many investment trust shareholders will be seeing cash coming back into their accounts over the next few weeks, because there are quite a lot of trusts that are having tender offers or takeovers or winding ups and winding downs. So you'll probably see some cash coming into your portfolio. And I don't think I would necessarily rush to put that back in too quickly. And we might see a bit more profit taking in some of the areas that have done very well over the last few months. Which certainly includes growth capital.
So that was Andrew McHattie, editor of the Investment Trust newsletter. Moving on, and for a different kind of perspective, I talk next to my old friend and familiar name on this podcast, Charlie Morris, CEO of ByteTree Research, former head of asset allocation at a large city bank back in the day, now producing his own independent research at ByteTree, which I can thoroughly recommend. So, Charlie, first of all, I got to ask you a quick question about the markets, and I guess I got to mention this small fact of the UK election coming up. Do you have any thoughts on that? It seems to be a slam dunk according to the bookies. What are you afraid of, and what are you hoping for, without giving away any kind of secret affiliations you might have with it?
Hey, Jonathan, nice to be here. What am I afraid of in politics? Everything, I think, frankly. There's a lot to be afraid of right now, isn't there? And what am I hoping for? A smooth, clean, decisive outcome. And hopefully we can put our hatred of politics to bed for a little while at least. It's a funny old one, isn't it? Because if you look at Rishi Sunak, he's actually done quite a good caretaker job. If you put your technocrat hat on, you can't really criticise all that much. And you took over an unsteady ship and he steadied it, and all the things that we were really upset about a couple of years ago, many of them have calmed down. But somehow he just hasn't got the ability to rally the country and make everyone happy, which is this magic quality that politicians need. And so we're going to vote for the other guys, probably. And the other guys, we don't know who they are, what they stand for. We know it's going to be worse than the current one, probably, or most of us think that, but we'll vote for them anyway. So, I guess that's where we are.
Yes, I think Rishi's challenge has been obviously to do something with the Tory party, which seems to be in one of its periodic self-destruct modes. The most successful political party in history, they always say, but it's had some spectacular downturns as well, I think it's fair to say. And we're seeing one of them at the moment. I do remember, if you cast your mind back, as you can, and I'm afraid I can, to 1997, when Blair won in somewhat similar circumstances, you might think, though perhaps we had a much clearer idea of what they were thinking of doing. But of course, two of the things they did soon after starting the new Labour government was, first of all, they abolished the tax credit on dividends for pension funds, which has been a hugely costly thing, just to raise some money in the short term. They thought it was a bit of a coup. And then they sold most of the gold reserves at just the low point in the cycle. So I guess there's always a risk that in their effort to make an immediate impact, they may do something stupid, and that would be concerning, wouldn't it?
Except that on their first day in office, you remember, they gave independence to the Bank of England.
Yes, they also did that, to be fair.
Which was a very smart, shrewd move, because it really caught the Tories on the back foot. And I think that people probably don't really remember pre-97, which is, really quite a long time ago, isn't it? And pre-97, we used to have this Chancellor of the Exchequer, the cameras following him around asking where interest rate would be next month. He was sort of more famous than the PM in many cases, wasn't it? Because everyone wanted to cut. And he realised he could please everyone by cutting interest rates. And I think that's one of the reasons why, if you look at the countries that had managed interest rates like we did, inflation was probably a little bit higher than in countries with independent central banks. But of course, the independent central banks aren't independent anymore. So there's the other rub. But I do think that they will definitely have a rabbit to pull out of the hat in something. My personal view is they should be enabling the Bitcoin ETFs, but I'm sure I'm wrong.
That's a specialist interest of yours, of course. Let's talk about then a little bit about what's happening with the markets. And in particular, I'm interested in your thoughts about the investment trust sector, which, as you know, is our specialist concern. We had a conversation about 6 months ago, or back in the autumn anyway. We both picked up on the fact that it did seem like finally we were going to see some kind of turning point in the performance of investment trusts after seeing these discounts widen out massively across the spectrum and in the alternative space in particular. And so far, I guess if you look back to October or so on, it has been quite rewarding if you've managed to pick the right investment trusts. Tell us about the ones that you've actually been looking at and been adding to your portfolios.
Yes, I think that I've been looking at the ones with big discounts that are liquid and large, and the ones you sort of felt you had time on your side. So even if you were tactically wrong in the particular asset pot at this moment in time, you said, well, the discount's big enough, the liquidity's there, it will come good over the next 2 or 3 years. That's sort of been my theme, and to own lots of them. And so you can negate the fact that it might not be the perfect choice in all cases, so therefore just own a basket of them. So that's what I did, but I never gave up liquidity. So I didn't buy the small ones, so there's still opportunity there for individual investors. But when you're grouping lots of investors, you really have to think about that. It's very important. And I suppose the market has been pretty unkind to small stocks and small trusts and so forth. Part of that is regulatory, part of that's the death of the UK stock market that we hear about. But there's also been private assets, private equity and infrastructure. Anything that's underlying illiquid really hasn't been rewarded very easily or quickly. And so it's the sort of the HgCapitals, the Caledonia Trusts, Pantheon. So these are the sorts of things I've been looking at. I think there's still a hell of a lot more to go. The big unlock will be, is private equity okay or not? Of course, the FCA think it's great. And they're truly expert in illiquid investing because they banned the Bitcoin ETF, which is hugely liquid. But on the other side of life, you've got the Bank of England that's a bit concerned about private equity. Which is it? But at 43% discount, which you're seeing on some of the pure play trusts, there's enough in the price to know that the answer's somewhere in the middle.
As well as some of those names you mentioned, you've also taken an interest in BlackRock World Mining. Is this a situation where, to have a view about commodities and the mining stocks, for example, that actually there is a discount on BlackRock World Mining and you can get a better return from that than you can by, say, putting money into an ETF that's tracking whatever kind of commodity index you're trying to track? Why did that one catch your eye?
Well, like you, Jonathan, when one of the big ones has a discount and you can understand why and you like what's in it, buy it. It's very simple. And in that case, we started to see strength in copper a couple of months ago and in other metals. So I had a look at the trust, noticed it was on a 10 discount, which is unusual because recently it's actually traded quite close to par. And the result was that the commodity stocks went up a bit and the discount came straight in. So it's quite nice, So when the underlying went up 5% or something, discount comes in, you're up 15% in a short space of time. And with not that much risk. And of course, if you want to bank it, then you switch to an ETF once the discount's in. But, we don't have to be that excitable in our trading strategy. But certainly, the lesson in the long run is that when all your investment trusts are at par, then it's probably a good time to consider switching to open-ended funds, because at least you don't have the risk of going back the other way.
Do you have a specific view about gold, which obviously has been performing exceptionally well, confounding a number of people, as so often? And why is gold so strong, given the environment we're in at the moment? Is it all geopolitics, or is there something else going on here?
I think there are a few reasons. Geopolitics is certainly the reason why it didn't go down when interest rates went up. So everyone's picked up on the real interest rate jump, where real interest rates correlated very highly with the gold price, negatively, of course. And so when you had easy money from central banks, that's good for gold. And when you've got hard money environment, which we somewhat do now, then that's supposed to be bad. But then other events came in, and I think it was the confiscation of Russian assets. So I think it's becoming quite a familiar story now. But the demand from the Chinese public sector has been very strong, which has counteracted all the selling pressure from Western institutions. We've also got the Chinese general public, who, let's face it, don't have the same investment choice we do. We can buy small caps, mid caps, large caps from many, many different countries, and we can buy other strange things as well. In China, you can buy a property, you can buy the stock market, you can buy gold. That's about it. And so it's going to have elevated status from time to time. Also, I think you've got to look at the US budget deficit and budget deficits in general. Some people will tell you that the gold price in the long run kind of follows the money supply. And the money supply over the last 3 years has been pretty flat, which should cause a bear market in equities, but it hasn't. We've had a pretty strong market, particularly in large caps. And so we wonder, where's all the money coming from? And you kind of do the investigation, and it's largely down to general liquidity in markets, but also these big public deficits. And you think, well, here we are in an election, going back to that, and there's a US election in November. Thankfully, ours will be done before theirs will be. But no one's going to be on the soapbox in the next 6 weeks here and 6 months there, talking about balancing the books on either side of the political spectrum. And so therefore, if it's no longer even relevant to talk about protecting the value of money, then at what point do you just say, well, the ultimate hedge for that through history, across many, many different regimes in history and in different continents, has been gold, and it's been the perfect hedge over time. And indeed, gold is still ahead of the S&P 500 in the 21st century, including dividends. Gold doesn't have a dividend, and it's still ahead of the S&P 500, including dividends, which is just remarkable.
It is a remarkable statistic, and it's certainly, as you say, telling us something about the world. And it's telling us something probably about aspects of the world that a lot of people aren't actually spending much time thinking about. And politicians certainly aren't talking about, as you say. That's absolutely right. So does this all add up to saying that, this is an election year, an important election year for lots of places? They're normally quite good for stock markets, mainly because it's all about politicians promising rather than actually doing anything. And then the first 2 years of the US presidential cycle, what do you think? We've still got some risks out there ahead next year?
Plenty of risks, Jonathan. I think, go back to this mounting debt GDP ratio in peacetime. It is a concern, and there's really no one doing anything about it. That is a problem. And then it's really the second bout of inflation, because inflation, if you go back to the 70s, and indeed countries like Argentina and Turkey and so forth, inflation tends to come in steps or in events, rather than being a smooth thing. When we talk about 10% inflation, you sort of assume that it comes equally month by month. It really doesn't. It bounces around like no end. And so there are parts of the stock market telling you there's another bout of inflation coming. For example, commodity prices, for example, gold. And then you see the events on the ground of the problems with the Suez Canal, all the tariffs going up against China for EVs and batteries and green technologies and so forth. And you add it all up together, you say, well, that's what you do in an inflationary environment and heavy defense spending. All of these things together, you say, well, you might have cured the supply blockage from the pandemic, but surely you're brewing up for something else to come. And every time there's an accident in the economy, which, there'll be one at some point, I don't know what it will be. We were expecting one a couple of years ago, which never seemed to happen. And interest rates, surprisingly, have done so little to put the brakes on the economy, although some would disagree with that. But at some point, it will weigh. And when it does, the solution is always more stimulus. And so that just means we have even more debt. It must become a problem. It must become a problem, and the only solution is inflation. So I think to assume that all's well and we're back to the noughties or the teenies on low inflation and free credit markets sustainably, I think that's ambitious. Plenty of things that get in the way of that.
Well, I'd certainly agree with that. It is difficult to work out a scenario in which governments can fund all the things they want to do without having some impact on interest rates. They're not going back down a long way as far as I can see. Would you agree with that?
Well, probably. And of course, if you go back to the last two great bear markets, 2022 was a great bear market if you were a no-profit tech stock. But if you were a normal company, it wasn't a great bear market. The great bear markets were sort of 2000, 2002 and 07, 08. And they were pretty devastating and pretty quick. And let's not forget that they happened whilst interest rates were being slashed.
Exactly. It's not a coincidence. So I guess the message is be careful what you wish for, really. If you're really projecting that interest rates are going to be back to 1% in some time, then basically that means we're going to be in a really bad place if that happens.
By the way, it might be quite good for UK REITs. My simple observation about working from home, which is a very important impact on commercial real estate, as is interest rates, is my station car park. It was expanded comically about 2 weeks before the first lockdown. So it was in about February 2020. We had this beautiful new huge car park compared to the old one, nearly twice the size. Then all it was useful for was a go-kart track for the next couple of years during lockdown, because it was literally 2 or 3 cars in there, key workers or what have you. And then now it's bursting at the seams. And I promise you that it won't be on a Friday. And there was a time that it was still quite light on a Monday. But now, Monday through to Thursday, it's a pretty busy car park. And that's hardly the world's most resilient or robust macroeconomic indicator. But it does tell you there's a lot of people going into town and doing their job, which I think does indicate that the worst of this idea, the fear that there's a permanent change in working conditions, I think it's probably exaggerated. And the normalization is probably found a happy medium. Any firm with a decent CEO has got his people back into the office.
Come back to the election, just to finish off, the Labour Party's promise if they get in to renationalise the railways. So all those happy commuters, it might be interesting to see how the performance of a renationalised railway industry over the next 5 years performs compared to what the privatised companies have been able to achieve, which is, let's be honest, not been brilliant either.
It depends where you live. It really does. I think in the northeast they've had a bad experience, and southern's always been a bit troubled. But, I use Greater Anglia and we've got new trains and it's rather good.
So that was Charlie Morris, the CEO of ByteTree Research, talking about some of the things that are on his mind and on his agenda at the moment as we go into this political window of elections coming up both here and in the US. Next week, just to give you advance warning, the podcast may be a little shorter than normal because I'm away for a few days, but I will still have time to talk to HgCapital, one of the most successful listed private equity trusts, and a company which for the last 2 years running has been the very best performer over 30 years in the long-run performance tables I compile each year for the Investment Trusts Handbook. So definitely something to listen out for there.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.